You buy a ticket to a concert, right?
Sure.
That ticket has a price, but its real worth hinges on the band actually playing. If they cancel, your ticket's worthless.
Makes sense.
The band playing, that's the underlying thing that gives the ticket value.
Mm.
In the world of finance, derivatives work similarly. Their value is tied to the performance of something else.
Turning finance into a beat, music and wisdom for you and me.
Welcome back to the deep dive,
Yeah,
where we take the sometimes chaotic noise of finance, and try to find the signal,
right.
that clear melody of understanding.
Absolutely.
I'm King John.
And I'm Jen Moulton.
For a clearer and more engaging understanding of options, we've composed an educational song. If you haven't explored it yet, we invite you to view it on the Deep Beat channel.
Options, let's break it down. A contract to trade, no need to frown. It's your right.
And today,
Glad to be here.
we're tuning into a topic that can sound like a foreign language
Oh, yeah.
to new investors.
For sure.
Yes,
Yeah.
our mission
Yeah.
to break down the basic rhythm
Okay.
of how options work, so you can decide if they might have a place
That's right.
in your investment mix.
But by the end of this deep dive, you'll have a solid grasp on what they are, why they matter, and how they fit into the grand scheme of things.
Sounds good to me. Today, we're diving deep into the world of options and derivatives.
You're it.
Get ready to unlock a whole new level of investing know-how. You might be surprised to learn that these tools have been around for much longer than you might think.
That's right. We're going to demystify these powerful financial instruments and help you understand how they can fit into your investment strategy. The fascinating thing is, the principles behind derivatives have been around for centuries.
So first things first, what exactly are we talking about when we say derivatives?
At their core, derivatives are financial contracts. But here's the catch. Their value isn't inherent, it's derived from something else.
Derived, like secondhand value.
Kind of, but more dynamic. Think of it like this. You buy a ticket to a concert, right?
Sure.
That ticket has a price, but its real worth hinges on the band actually playing. If they cancel, your ticket's worthless.
Makes sense.
The band playing, that's the underlying thing that gives the ticket value.
Mm.
In the world of finance, derivatives work similarly. Their value is tied to the performance of something else, underlying asset.
So we're not just talking about stocks and bonds here.
You got it. Stocks and bonds, those are the fundamental building blocks. Derivatives, they're like an extra layer, a bet on top of those basics.
Okay, again, let's lay the groundwork here. So when we talk about options,
Yeah.
we're entering the realm of derivatives.
Mm.
What exactly does that term signify? It sounds a bit abstract,
But the core idea is quite straightforward. A derivative is simply a financial contract
Okay.
whose value derives its worth from something else,
Okay.
an underlying asset.
Right.
Think of it as a financial shadow
Okay.
whose shape and movement depend on the object it's cast by.
So what kind of objects are we talking about here? What can be this underlying asset?
Just about anything with a fluctuating price. We're talking tangible things like commodities,
Yeah.
oil, gold, even agricultural products like wheat.
Wow.
Then you have financial instruments like stocks and bonds,
Makes sense.
and even more abstract concept, interest rates and currencies can serve as the base
Wow.
for derivatives. If its value can go up or down, it can likely be the underlying asset.
So why create these shadow contracts in the first place? What practical purposes do they serve, for investors or businesses?
They serve several really important functions.
Okay.
One key one is hedging. It's like buying insurance
Okay.
for your investments.
Got it.
If you own a stock, you can use a derivative
Yeah.
to protect yourself against a potential drop in its price. Another is speculation, where investors try to profit
Okay.
by making informed bets on which way the price of an underlying asset will move.
I see.
And sometimes derivatives allow you to access markets
Yep.
or asset classes that might be difficult or costly to trade directly.
Okay. Starting to get the picture. But derivatives, they sound like some fancy modern invention.
You might be surprised. The concept behind derivatives has been around for centuries. You know the ancient Greek philosopher Thales?
Vaguely. Refresh my memory.
Well, he essentially secured a contract for olive presses, predicting a bumper olive harvest.
Mark Gookie.
Right. When the harvest boomed, He rented those prices out at a much higher price. That's a contract based on a future event impacting value, the essence of a derivative.
So ancient Greece had its own version of playing the market.
In a way, yes. But if we're talking organized markets, one of the earliest examples is the Dojima rice exchange in 18th century Japan.
Rice exchange.
Yep. They traded rice futures contracts. Rice was like gold back then, especially for samurai who were paid in it.
I see.
These futures contracts helped them lock in future selling prices, making their income more predictable.
Smart move.
Yeah.
So what exactly makes a derivative contract official? What needs to be in there?
These contracts, they have to be super specific to avoid any confusion. They lay out all the conditions, like the dates when things happen, how the final value is figured out, and a clear definition of the underlying thing we talked about.
Like a legally binding agreement.
Exactly. It also specifies what each party has to do and the notional amount.
Notional amount. Now there's another term.
Think of it like the size of the bet you're making. It's the reference point for calculating your wins or losses, even if the actual money changing hands at the start is much smaller.
Okay, starting to click. Now, you mentioned that you don't actually need to own the underlying asset to trade a derivative, right?
That's the interesting part. It's like car insurance. You buy a policy to protect yourself in case of an accident.
You don't need to crash to get value from the insurance.
Precisely. Derivatives let you play the field of risk without owning the actual asset. It's all about managing and speculating on those price movements.
So the concept of options trading has been around for thousands of years. But let's fast forward to today. What are the main types of derivatives investors should know about?
There are three main categories: forwards, futures, and options. Each has its own characteristics and use cases.
Let's break those down one by one. What are forward contracts all about?
A forward contract is a private agreement between two parties to buy or sell an asset at a specific price on a future date. It's often used by businesses to hedge against potential price fluctuations.
So if a business is worried about the price of a raw material going up, they could use a forward contract to lock in a price today, even if the delivery is months away.
Exactly. Let's say you're a bakery owner and you need a steady supply of wheat. You could enter into a forward contract with a farmer to buy a certain amount of wheat at a set price in 6 months. That way, you know exactly what you'll be paying, even if the market price of wheat goes up unexpectedly.
That's a great way to manage costs and avoid surprises down the line. But what happens if the price of wheat goes down? Wouldn't the bakery be stuck paying a higher price than the market rate?
That's the trade-off with forwards. While they protect you from price increases, they also limit your potential gains if the price drops. Forwards are all about certainty and risk mitigation, not necessarily maximizing profits.
Got it. So forwards are like a price guarantee for both the buyer and seller. What about futures contracts? How are those different?
Futures contracts are similar to forwards in that they also involve agreeing on a price today for a transaction that will happen in the future. However, futures are standardized and traded on exchanges, making them more transparent and liquid.
So it's like a more formalized and public version of a forward contract.
Exactly. With futures, you're not just dealing directly with another party, you're participating in a regulated market. This added transparency and liquidity comes with its own set of considerations, though.
Such as?
Well, futures contracts are subject to daily price fluctuations and margin requirements. Margin is essentially a good faith deposit that traders have to put up to cover potential losses. It can amplify both gains and losses, so it's important to understand how margin works before trading futures.
That makes sense. So we've covered forwards and futures, which are both about agreeing on a future price for an asset. Taking a short break now. Up next, a deeper look into options, so stick around.
Music and wisdom for you and me.
What about options? They seem to be a bit more mysterious.
Options are indeed a bit different. They give the buyer the right, but not the obligation, to buy or sell an asset at a specific price, known as the strike price, within a certain time frame. This flexibility is what makes options so versatile.
So with an option, you have the choice to go through with the transaction or walk away.
Yeah,
That sounds less risky than a forward or futures contract.
it can be. You buy a call option if you think the price of an asset will go up, or put option if you think it will go down. But there's a cost associated with that flexibility.
What kind of cost?
You pay a premium to buy an option contract. Think of it as the price of having the choice to exercise the option or not. The higher the potential profit, the higher the premium you'll pay.
So when we talk about options, are there different kinds of rights we can buy?
Yes, there are two main types. Okay. Call options and put options.
Got it.
A call option gives you, the buyer, the right to buy the underlying asset at a specific price that's the strike price.
Okay.
We'll talk more about within a certain time frame.
Right.
Conversely, a put option gives you the right to sell the underlying asset at the strike price
Got it.
within that time frame.
Strike price. So that's the predetermined price at which the transaction could happen
Yes,
if the option is exercised.
exactly.
What are the other essential elements of an option contract we need to understand?
Besides the underlying asset itself, whether it's shares of a particular company,
Right.
a quantity of gold, or something else, and the strike price,
Okay.
you also have the expiration date.
Right.
This is the deadline,
Right.
the last day.
Got it.
The option can be exercised. And as we've mentioned, there's the premium, the price you pay up front
Okay.
for the option contract.
So we have the asset, the price you can trade at strike,
Uh,
the finish line expiration,
that's right.
and the initial cost premium.
Yes.
Now let's try to paint a clearer picture of how these things work
Let's
in the
throw
real
that-
world,
Okay.
especially for someone, just starting to explore this.
Imagine you're interested in buying a vintage guitar
Okay.
that a collector is selling for $1,000. You think it might become more valuable,
Okay.
but you're not entirely sure you want to commit just yet.
Makes sense.
You could ask the seller for an option to buy the guitar
Okay.
at $1,000
Okay.
within the next month. For this option, you might pay the seller a small, non-refundable fee,
Okay.
let's say $50. If during that month, the value of similar guitars
Yeah.
suddenly jumps to $1,500, you would likely exercise your option, pay the $1,000, and essentially get a $1,500 guitar for $1,050 total.
Wow.
If, however, the guitar's value stays flat or even drops,
Yeah.
you could simply let your option expire.
I see.
The most you've lost is the $50 you paid. Got for the option.
That analogy of the guitar
Yeah,
makes the right, not the obligation, really click.
yeah,
So a call option,
yes.
the right to buy,
Mm-hmm.
is like reserving something at a set price.
Uh-huh.
What about a put option?
Okay.
The right to sell. How does that work in a relatable way?
Think of it like this. Say you own shares in a tech company,
Okay.
and the stock is currently trading at $100. You've made a good profit,
Okay.
but you're a little nervous
Yeah.
about an upcoming product announcement
Okay.
and worried the price might fall.
Sure.
You could buy a put option that gives you the right to sell your shares at $95 within the next 3 months.
Got it?
You'd pay a small premium
Okay.
for this protection
Right.
if the bad news hit.
Oh,
And the stock price plummets to $80, you can exercise your put option, essentially selling your shares at $95, limiting your losses.
so you avoid that extra $15 of loss?
Exactly. If the product announcement is great and the stock price soars to $120, you would simply let your put option expire, having only lost the premium.
Got it.
You paid for that peace of mind. It's like an insurance policy against a potential price decline.
Those examples really clarify the core mechanics.
Yeah.
Now, where does one actually acquire these option contracts? Are they traded like stocks?
Yes, absolutely. Equity options, which are based on individual stocks, are very commonly traded on exchanges.
Okay.
These exchanges standardize the terms of the option contracts,
Got it.
such as the number of shares one contract represents,
Okay.
typically 100 shares of the underlying stock.
Right.
When you buy or sell an option, the transaction is usually settled through centralized clearinghouses.
Okay.
This system provides transparency and liquidity,
Okay.
making it easier to find buyers and sellers and ensuring the smooth functioning of the market.
But how do you know whether to exercise an option or not? What factors should investors consider?
That depends on several things, including the current market price of the underlying asset, your outlook on its future price movement, and your risk tolerance. If the market price is higher than the strike price for a call option, it would be profitable to exercise. But if it's lower, you would let the option expire and only lose the premium you paid.
So it's all about weighing the potential profit against the risk of loss.
Yeah.
But there are different types of options contracts, right? Like American and European options.
Yeah.
What's the difference between those?
Yeah, right. American options give you the flexibility to exercise the option at any point before the expiration date. European options, on the other hand, can only be exercised on the expiration date.
So American options offer more flexibility, but European options might be simpler to understand. What factors would make someone choose one over the other?
The choice depends on your trading strategy and the specific underlying asset. American options are generally more valuable because of the added flexibility, but they may also come with a higher premium. It's all about finding the right tool for the job.
This is all incredibly helpful information. But let's not forget about the risks involved with options. They're not exactly risk-free, right?
That's absolutely right. Options can be risky, especially if you don't understand how they work or if you're not careful with your trading strategy. Leverage, which allows you to control a large amount of assets with a relatively small investment, can amplify both gains and losses.
So are derivatives like gambling? Is it all just a matter of luck? We're stepping away for a quick break, but don't go anywhere. When we're back, we'll explore differences between gambling and option trading. Stay tuned.
Music and wisdom for you and me.
That's a question we hear often. While there are some similarities to gambling, like risk and uncertainty, there's a key difference: informed trading versus reckless speculation.
Could you explain that a little more? Where's the line between informed trading and just throwing darts at a board?
Informed trading involves doing your research, understanding the underlying asset, having a strategy, and managing your risk. You're making calculated decisions based on knowledge and analysis. Reckless speculation is just throwing money at something and hoping for the best without a solid understanding of the risks involved.
So it's all about approaching derivatives with a clear head and a well-defined plan, not just chasing quick profits or relying on gut feeling.
Exactly. Successful options traders aren't just lucky, they're skilled and disciplined. There are plenty of examples of massive losses from derivatives trading gone wrong, like the cases of Barings Bank and AIG, which highlight the importance of approaching derivatives with caution and a solid understanding of the risks involved.
Those are definitely cautionary tales. But besides the risks, aren't there also potential benefits to using derivatives?
Absolutely. One of the key benefits is diversification. Derivatives, especially options on futures, can help you diversify your portfolio beyond traditional stocks and bonds.
Diversification, that's a fundamental principle of investing. Right. Not putting all your eggs in one basket. How exactly do derivatives help with that?
They provide access to a wider range of assets and markets, including those that might behave differently than your typical stocks and bonds. Think of agricultural commodities like corn or wheat. Their prices are influenced by factors like weather patterns and global demand, which might have little to do with what's happening in the stock market.
So if you're heavily invested in tech stocks, which can be volatile, adding some exposure to agricultural commodities through options on futures could help balance out your portfolio.
Precisely. It's all about spreading your risk and finding investments that complement each other. If one part of your portfolio is struggling, another part might be performing well, helping to smooth out your overall returns.
That's a brilliant strategy. Can you give us some specific examples of how a beginner investor might consider using options on futures for diversification?
Let's say you're mainly invested in tech stocks, which, as we discussed, can be volatile. You could consider adding options on futures for agricultural commodities to your portfolio. If tech stocks take a downturn, agricultural commodities might hold steady or even go up, cushioning the blow to your overall portfolio.
I see, so it's like having a backup plan for your investments. If one area underperforms, another area might pick up the slack.
Exactly. It's all about managing risk and creating a more resilient portfolio. But remember, options on futures can be complex, so it's important to do your research and understand how they work before diving in.
This has been an incredibly helpful overview of derivatives. I'm starting to see how they can be powerful tools for managing risk, diversifying a portfolio, and potentially enhancing returns.
They can be, but it's crucial to approach them with caution, do your research, and never invest more than you can afford to lose. Derivatives are not a get-rich-quick scheme. They require knowledge, skill, and discipline.
That's great advice. We've covered a lot of ground today, from ancient Greece to modern-day investment strategies. What are some key takeaways that you want our listeners to remember?
The biggest takeaway is that derivatives, while complex, are powerful tools for investors who take the time to learn how to use them responsibly. They offer opportunities to hedge risk, diversify your portfolio, and potentially boost your returns. But they're not for everyone, and it's crucial to have a solid understanding of how they work before diving in.
Exactly. They can be a valuable addition to an investor's toolkit, but only when used wisely and with a clear understanding of the risks involved. Where can our listeners go to learn more about derivatives and continue their education on this topic?
There are many resources available. You can read books, take online courses, or even consult with a financial advisor. The key is to be proactive and seek out information from reputable sources.
That's great advice. We'll also be continuing our deep dive into derivatives in part 2 of this episode. What can our listeners look forward to learning about next time?
In part 2, we'll delve deeper into specific derivative strategies and how to apply them in real-world investing scenarios. We'll also discuss the importance of risk management. Stay tuned.
Music and wisdom for you and me.
Welcome back. You're now equipped with a basic understanding of derivatives.
Yeah.
Let's shift gears and explore the specific ways you can leverage these financial instruments to enhance your portfolio and manage risk.
Okay, this is where it gets really interesting. We're moving from theory to practical application. I'm eager to learn how these concepts translate into real-world investment strategies.
Excellent. Let's start with the concept of hedging. Remember our bakery example with the forward contract on wheat? That's a classic example of hedging.
Right. The bakery locked in a price for wheat to protect themselves from potential price increases.
Precisely. Hedging is all about mitigating risk. It's like buying insurance for your investments.
Oh,
Let's say you own shares of a company and you're worried about a potential drop in the stock price.
so you could buy a put option.
Exactly. A put option gives you the right to sell the stock at a predetermined price. If the stock price falls below that price, you can exercise your option and limit your losses.
Oh, that's a smart way to protect your downside.
It is, and it's just one example of how derivatives can be used for hedging. There are countless other strategies out there.
Now, what about using derivatives for speculation? That's where things can get a little riskier, right?
Yes, speculation involves taking on more risk in hopes of generating higher returns. It's about trying to profit from price movements rather than just protecting against losses.
Okay.
If you think the price of gold is going to go up, you could buy a call option on gold futures.
Oh, okay. So a call option gives you the right to buy gold at a predetermined price if the price of gold rises above that price. You can exercise your option and make a profit.
That's one way to do it.
But of course, if the price of gold goes down, you could lose your entire investment.
That's the risk you take with speculation. It's important to remember that derivatives can magnify both gains and losses.
So it's crucial to have a solid understanding of the markets and the risks involved before you start speculating with derivatives.
Absolutely. And it's also important to have a well-defined trading strategy and to manage your risk carefully.
Okay. This has been an incredible journey into the world of options and derivatives. We've covered so much ground from the basics to specific strategies and risk management principles. What final words of wisdom would you leave our listeners with?
The world of finance is constantly evolving, so stay curious, explore different perspectives, and always strive to expand your knowledge. Remember, options and derivatives can be powerful tools for investors who use them wisely, but they're not a one-size-fits-all solution.
That's a great point. It's important to do your research, understand the risks, and if you're ever unsure, consult with a qualified financial professional. Don't be afraid to seek guidance and learn from those with more experience.
Absolutely. And remember, investing is a journey, not a destination. Enjoy the process, learn from your experiences, and never stop growing your knowledge.
Thanks for joining us on this deep dive into options and derivatives. We hope you've gained valuable insights and are feeling more confident about navigating the world of investing. Until next time, happy investing.